Good evening and welcome to our session today, my friends. The last time that we met, we were dealing with the uh, statement of profit or loss and other comprehensive income of a company. We managed to prepare it, and the two most important notes, that is the profit before tax and the director's remuneration. We managed to deal with those ones. So today I want us to look at the statement of changes in equity. Right. Now, let me just come here. Right. There will be a major difference between the statement of changes in equity of a company and the ones that we used to do for a sole trader in the partnership. Right. So let me just quickly give you the format. Right. First of all, we start with the heading. A statement of changes in equity is a statement for a year. Changes in equity of Eugenius Limited for the year ended. So it's for the year. Right. Let's say 31 December 2023. Right. We create columns for the various items that we have. Right. We would create columns for the following: ordinary share capital. Right. Our share capital in a company can be divided into ordinary share capital and preference share capital. But at a later stage, we shall learn on a situation whereby preference share capital is not part of equity. So if it's a liability, it won't feature in our statement of changes in equity. Right. Then we'll have a retained earnings. Then we'll have our revaluation surplus. Then we'll have our mark to market. We can have our asset replacement reserve. Then we can have our total equity. Right. We start with balance at the beginning of the year, which are the balances that are coming from the previous year. Right. So if we had balances from the previous year, then we have movements during the year. All right. We can have our proceeds from issue of shares. It's possible that the company can issue shares. So they will be added. Either if they're ordinary shares, we add to the ordinary share capital. If they are preference shares, we add to the preference share capital. We can also have what we call capitalization shares. I think we did that in our earlier classes. Capitalization shares are shares that are issued to existing shareholders for free. They won't pay for them. Right. They will add to the ordinary share capital and then we'll subtract from the retained earnings. A capitalization shares or bonus shares are issued from our retained earnings. As a result, they are added on ordinary shares and subtracted in retained earnings. As a result, there will be nothing on the total because a plus and a minus will give us a zero there. Right. Then we can have total comprehensive income. Our total comprehensive income comes from the profit or loss that we did in our previous class. Right. The profit for the year will go under the retained earnings. Then the gain on fair valuation of assets will go under the revaluation surplus. Then gain on fair valuation of investments will go under the mark to market. Right. So that will be what will be shown there. Then we can have transfers to asset replacement reserve. Right. A asset replacement reserve is a reserve that is created in order to replace assets in future. So if there is any assets that have to be replaced, we know that it needs a lot of money. So it cannot just be raised in a day. So what happens? Organizations, they save and create a fund. Right. So that fund, where does it come from? It comes from retained earnings. And it will go to mark. And it doesn't affect the total because it's a plus and a minus. Right. We can also have dividends. Right. Both interim and final. Right. Interim dividends, as we illustrated in our previous classes, are dividends that are issued at the beginning of the year. Sorry, during the year, interim dividends that are paid during the year. And final dividends are those dividends that are paid at the end of the year. Right. Then we'll have our balances at the end of the year. There can be one or two things that I didn't mention, which we shall meet also along the way. But these are the most common items that we have. We can also have a redemption of shares. A redemption is the company buying back the shares. So it will subtract on the share capital. Right. Any questions so far? Right. So now I would like to use this question that I sent to you earlier on for illustration. We're going to use question 3. Right. The following is an extract from the trial balance of Wild Things Limited on 28 February 2017. Right. Then we are told that calculate the profit for the year in the statement of profit or loss and other comprehensive income of Wild Things Limited for the year ended 28 February 2017. Then using the information calculated in A above, prepare the statement of changes in equity of Wild Things Limited for the financial year ended 28 February 2017. You should note that the profit for the year, we calculate it in the statement of profit or loss and other comprehensive income. But when they just say calculate, they are not saying prepare the statement of profit or loss. You can just, you don't have to do the formal, necessarily the formal preparation. Right. But before we go to that, let's deal with additional information. Right. Wild Things owns an office building in Sandton, which was acquired on 1 March 2013 at a cost of 5.5 million. Land 1.5, building 4 million. The property was available for use as intended by management on acquisition date. The useful life of the building was estimated to be 20 years, and a residual value of new was allocated to the building upon initial recognition. Both the useful life and residual value of the building remained unchanged. Right. Wild Things Limited adopted a policy to revalue its owner-occupied land and buildings. Revaluations are made with sufficient regularity to ensure that the carrying amounts does not differ materially from the fair value at year end. On 1 March 2016, Mr. J. Smith, an independent sworn appraiser, revalued the property for the first time and determined the fair value of the land and the net replacement value of the building to be 1.7 and 6 billion respectively. The inexperienced accountant of World Things Limited did not account for the revaluation or any depreciation on the building for the current year. So there are two things that we need when we do the statement of changes in equity. Number one, there is a revaluation. The revaluation will go to the revaluation surplus. Number two, there's depreciation. This depreciation, which has not been accounted for, will also be part of other expenses because they said it has not been, so it will be part of these other operating expenses. So we have to do calculations on that. So now let me do calculations first for this question. Right. Please stop me if I'm a little bit. I know it's Friday. You want to enjoy your Friday, but it's useless if we don't understand. Right. So I would start with additional information one. Right. We have land and buildings revaluation. Land revaluation, sorry. Let's start with the land, or maybe let's start with the land revaluation. Right, our land, we are told that it was bought from 1.5. And now it has been revalued to 1.7. So there's an increase of 200. And this revaluation was for the first time. So we'd say 1.7 minus 1,500,000, which is equal to 200,000. Right. Then buildings. Right. It's unfortunate that we've got this complicated calculation, which I don't expect you to be asked, as they don't normally ask the revaluation of buildings these days. But I will just illustrate it. The cost, because you never know. Right. The cost of this building was 4 million. So say 4 million. Right. Then the accumulated depreciation. On 29 February 2016. We are told that this asset, the depreciation was provided. It is a 20-year life with a residual value of new, and they had been bought on 1 March 2013. Now on 28, I'm ending on 28 February 2016 because they were revalued. The building was revalued on 1 March 2016. If there is a revaluation, first of all, you have to find the carrying amount of the asset prior to the revaluation. We have to find the carrying amount of the asset prior to the revaluation. That's why you see that I'm first stopping on 28 February 2016, so that we find the carrying amount, so that we can find out then on 1 March when it was revalued, then we can be able to calculate the revaluation. So this had been bought on 1 March 2013. By 28 February 2016, it had been there for 3 years. So to calculate our accumulated depreciation, we would say 4 million divided by 20 times 3 years. There is no residual value. So we'd say 4 million divided by 20, multiplied by 3. What do you get?
$600,000.
It's what?
600,000.
Thank you, boss. Right. Then we get our carrying amount on 28 February. Which is the date that the revaluation took place. So we get that it was 3.4 million. All right. Then our depreciation for this year. Okay, sorry. First of all, before we calculate the depreciation, we have to find the revaluation. So on the date that the revaluation took place, this asset was 3.4. Then it was revalued by our qualified independent appraiser to 6 million. So our revaluation was 6 million minus 3.4. Of which you get 2.6. Right, then we get our total. $6 million. Right, then our depreciation for the year. If there's a revaluation of a building, according to IAS 16, the depreciation for the current year now has to be calculated based on the new gross carrying amount of the asset, which is 6 million. We will no longer calculate it on the original price of 4 million. We will now calculate on the 6 million. So we now say 6 million. And again, we will no longer use the useful life of 20. Remember, the original useful life was 20, but 3 years have already passed. So we'll now use the remaining useful life, which is 17 years. So you will no longer use the original, you now use the remaining useful life, which is 17 years. Right. We'll then get 352,941. So that will be our depreciation. I repeat, whenever in a building is revalued for the current financial year, we will no longer calculate our depreciation based on the original cost price. It will now be based on the revalued amount. And we will no longer use the original useful life. We will now use the remaining useful life, taking away the years that have already passed. Right. Any questions there? So that means when we do our profit or loss, we should add this to operating expenses. And when we do our statement of changes in equity, we would add our revaluation. Let me just show our total revaluation. On the land, it was 200,000. Then on the building, 352,941. And our total would be 552,941. Any questions there? If there are no questions, we'll move on to additional information too. Right, on our additional information too, we are told that Wild Things entered into an unsecured long-term loan agreement on 31 August 2015. We are now, remember that we are now in the year 2016, which started on 1 March 2016. in the year 2017, sorry, which started on 1 March 2016. Right, the loan is repayable in 6 equal annual installments commencing on 31 August 2016. That means the first installment was paid on 31 August 2016 during the current year. The current year started on 1 March 2016 and ends on 31 on 20 February 2017. Right, the nominal interest rate is 15% per annum. Interest for the current year must still be provided for in the accounting records of World Things Limited and is repayable on 5 March 2017. So we need to find the interest for the current year. But we should be very careful. Remember, we don't want the interest from 31 August 2015, number one. We need the interest from 1 March 2016. In our profit or loss, we only include interest for the current year, which started on 1 March 2016. Then number two, we should be very careful that our loan changed. From 1 March to 31 August 2016, there was no payment. So the loan reduced on 31 August when they paid. So we have to know how much was the loan before the payment and how much was the loan after the payment. Because the interest before the payment will be based on the original loan, whereas the interest after the payment will be based on the loan after the repayment. Now let's go and check what is our loan. Right. This is the trial balance on 28 February 2017. And by then, the loan was now 2.7. So this loan on 28 February, this is after the payment of one installment on 31 August 2016. But if they said long-term loan 1 March 2016, then we could have known that it's the original, the beginning one. But they said these balances are on 28 February 2017. Because so that means this was after the payment. Now remember that the original loan was to be paid in 6 equal annual installments. Right, so that means each installment, let me just show you. That means each installment is equal to 2.7 divided by 5, which is equal to what? Why am I dividing by 5? The remaining loan is made up of 5 installments. Although it was 6 installments, one had already been paid on 31 August 2016. Right, what do we get?
540, sir.
Hello?
540,000.
Right. Then a original loan would be equal to 2,700,000 plus 540,000. What do you get?
It's 3,240,000.
That means the loan in the beginning, it was 3,240,000. That means from 1 March to 31 August, they were paying interest on 3,240,000. They were paying interest on 3,240,000. Right. Then from 1 August, from 1 September, they were now paying on 2.7 because they will have paid the 340. So that means, remember that our interest rate is 15%. So we'd say our interest for the first 6 months from March up to August, 6 months from March up to August, it will be 15% multiplied by the original loan, which was 3,240,000 because by then they had not yet paid the first installment. Then this is 6 months multiplied by 6 divided by 12. Then plus a 15% multiplied by 3,240,000. So 2.7 now for the last 6 months. Multiplied by 6 over 12. So you should be very careful. As long as there was an installment made during the year, it will mean that a part of the interest is on a different amount. Why? Because part of the interest was paid for the loan before the repayment, which was the 3,240. Then after the repayment of 540, the loan was now 2.7. What do we get?
$145,500.
245,500. That would be the, hello?
445.
445, okay. So that would be our interest. So. Right. Then we then look at investments. Included in investments at year end on 28 February 2017 is the following investment. Wild Things Limited acquired 4,500 shares in a listed company, Lion Limited. The shares are not held for trading. They are not held for trading. So what comes in your mind from our last session? If they are not held for trading, that means if there is any gain, it will go to market. Right, but we acquired with a long-term view. The directors of Wild Things Limited irrevocably elected at initial recognition to classify this investment as at fair value through other comprehensive income. The market value of the shares on the JSE at year end on 28 February 2016 amounted to 360. The shares traded at 95 Rand per share on the JSE on 28 February 2017. The increase in the market value of these investments has not been recorded yet in the accounting records of Wild Things for the current year. So there's mark to market here. Mark to market to record the increase in the value of shares. Right. So say additional information 3. Mark to market would say the new value 95 multiplied by, right, we know that the shares are now 95 Rand each, and the number of shares is 4.5. So it's 4.5 multiplied by the new value 95. Then we subtract the value at the end of last year, which was 360. Right. So to say times 4.5 minus 360. What do we get?
$7,500.
Hello?
67,500.
7,000.
67.
57.
67.
Okay, sorry, I can't hear you properly there. Thank you so much. 67,500. That would be, so this will go to market. Right. Then additional oh. Wild Things okay, was incorporated with an authorized share capital of 600,000. Right. The authorized share capital does not appear in our statement of financial position. It will be, or in a statement of changes in equity. It will only appear in the notes. In the statement of financial position, we include the issued share capital, or in our statement of changes in equity. Right. Now we're told that the the issued share capital of Wild Things on 1 March 2016 was as follows. So this was the issue. This is the opening balances on 1 March 2016. Right, then the following share transactions occurred during the current financial year and they have not been accounted for yet in the accounting records of Wild Things Limited for the current year. Wild Things Limited issued 75,000, 12% non-cumulative preference shares at £4 per share on 1 September 2016. Right, so they have a issue of non-cumulative preference shares, which will be 75,000 times 4. Right, so they have proceeds from issue of non-cumulative preference shares. Will be equal to that is 75,000 times 4. I guess we get 300,000.
Yes,
Can you
sir.
verify my figure if it's correct?
It's correct.
Okay, thank you. Right, then the next thing. On 31 October, Wild Things received proceeds of 1.2 when 600,000 ordinary shares were issued. There's no need to calculate them. We are given the proceeds, they are 1.2, the amount. Is that right?
Yes.
Then on 28 February 2017, capitalization shares were issued to all the registered ordinary shares at 150 per share at the ratio of 1 ordinary share for every 5 ordinary shares. Right. We'll have our capitalization shares. When they say capitalization shares, these are shares that are issued to existing shareholders for free. That means they don't have to pay for those shares. Right. Now, you first have to calculate the number of shares in issue prior to capitalization. Right, before the capitalization, remember these are ordinary shares. We had these ones here. That way, if they at the beginning 4.5 divided by 2, because they were for R2 each. Then we also had these ones, 600,000 that were issued. So to say, so you should be very careful. 4.5 divided by 2 plus 600,000. What do we get?
$602,250.
2,850,000. Is that correct? Right. So that means capitalization shares. Remember, you have to check the proportion with which the capitalization shares are being issued. Now we are told that the capitalization shares were in the ratio of 1 for every 5. 1 for every 5. So to say, one over 5 multiplied by 2,850,000. What do we get?
$570,000.
Thank you, sir. Then value of capitalization. Those ones are number of shares. We'll now say 570,000 multiplied by the value per share. We are told that these shares were issued at 150 per share. So multiply by 150.
$855,000. 855,000.
Thank you, sir. So that's the capitalization. And what do we do with capitalization shares? We add to the ordinary shares and then we subtract from the retained earnings. Any questions? Right. Then additional information 5. An ordinary dividend of 10 cents per share was declared to all registered ordinary shareholders on 28 February 2017. So including those, the bonus issue, because it was already issued. The company did not pay or declare any dividends during the previous financial year. Right. One thing that we should know is ordinary shareholders and non-cumulative preference shareholders. If they didn't receive a dividend last year, that dividend is gone. They will not receive it again. But these ones, the cumulative, that means they are going to receive dividend for 2 years. The one they didn't receive last year and the one for this year. So always, if they say a dividend was not paid and they are cumulative preference shares, you know that for this year, it will be for 2 years if they declare a dividend. And you should know that the fact that they just said they declared a dividend to ordinary shareholders. The fact that they declared to ordinary shareholders is automatic that they also declared to preference shareholders. Because you cannot pay an ordinary dividend without paying a preference dividend. Right. So what will happen here is our ordinary dividend is 10 cents per share. We multiply by the number of shares in issue by that date. Right. Our ordinary dividend would be equal to 10 cents multiplied by the number of shares. Remember, prior to the bonus issue, there were 2,850,000 shares, which we have above them. Then we issued ordinary shares capitalization of 570. So even capitalization shares, as long as they are in the share register by the date of the declaration of the dividend, they will also be entitled to the preference dividend. So what do we get there? And also note that when we're calculating the ordinary dividend, can you verify my figure there? Also make sure that when we calculate the ordinary dividend, we use the number of shares, not the amount of the shares. We calculate it based because it's 10 cents per share. So multiply by the number of shares. Is that figure confirmed?
It's correct.
Right. Then we'll have our preference dividend. Right. We'll have our cumulative preference dividend. Right. Would say this one will be 10% times 900,000 times 2. Because last year they didn't receive. So I would say 10% multiplied by 900,000 times 2. We get 180,000. Then non-cumulative we'll have 12% multiplied by these ones here. That way they at the beginning of the year. 1,350. They will not have for 2 years, only for 1 year. Multiply by 1,350. Then we also have a dividend for the new shares. 12% multiplied by, remember with these new shares for 300,000. But these shares were not there for the full year. They were only issued on 1 September 2016. So they've only been there for 6 months. Remember, our year end is 28 February 2017. So they've only been there for 6 months. So multiply by 6 over 12. Right. I want you to note the difference. With ordinary shares, we had these shares that were issued with proceeds, which are issued during the year, but we didn't look at the months. An ordinary dividend is not prorated. As long as the shareholder is in the share register on the date of the declaration, even if you bought last week, you get the same dividend as those shareholders who were there from the beginning of the year. But a preference dividend is a percentage per annum. So it will only get, if shares were issued during the year, they will only get a pro rata dividend. Right. What do we get there? Is what?
It says 180.
Thank you, sir. So they are not always the same. This is a coincidence, my friends. Don't just assume that they're always the same. It's just a coincidence that they are the same. So that was our dividend. Right. Any questions on our calculations? Once our calculations are done, answering will be very easy. Remember, our first question is calculation of profit. Right. And that's 28 February 2017. Right. We start with the revenue. There was no adjustment on the revenue. Right. So we'll just take our revenue here. Remember, on the profit and loss, we only have 2 adjustments. We had the interest, the finance cost, and the depreciation on number 1. So that means our revenue and our cost of sales, we'll just take them as they are 20 million and 8 million. So we'd say 20 million. Less cost of sales. Right. We get our gross profit. It will be 12 million. Right. Then we have our admin distribution. Let us start with our other income. There's no adjustment. 300,000, and our admin and our distribution, there's no adjustment. So we take them as they are. So I would say other income. $300,000. Then I will have my administrative expenses. We'll subtract. This is 2.4. Our distribution expenses. $240,000. Right. Then we'll have our other operating expenses. Just a minute. Just a minute. Right. Our other operating expenses, we have to add the depreciation. Our other operating expenses, we have to add the depreciation. Remember, it's 160 here. Then we add the depreciation. So say 160,000 plus the depreciation, which we calculated on additional information number 1, which was 352941. Right, we add together. Right. Then we have our finance cost, which is our interest. Which we calculated on additional information number 2, which was 445,500. Right. We then get our profit before tax. Right. Then our income tax expense. Which is here. $471,700. Then we get our profit for the year. Any questions? Right. Then we'll have our a part B. We'll then prepare our statement of changes in equity. Of Wild Things. For the year ended 28th February. Right. So we'll have to provide for these things here. Right. We have to provide for these things here. These two plus our three capitals and revaluation. Remember, we've got these three capitals. These ones. So I would have we normally start with our capital. Right. Sharp. Right. Now we'll have our ordinary share capital. Cumulative preference shares. All right. Then we have got okay, let me 10% cumulative preference shares. %, non-cumulative preference shares. Retained earnings. Revaluation. Mark to market. Then our total. In your exam, sometimes they will tell you that the total is not required. All right. All right. Right. We have balances at the beginning of year. Were given. For the share capitals, they are given here. Right. Then the other ones, are these ones. So we'll have to include them. We'll have 4.5. We include the issued, not the authorized. Right. We'll have right. Then we'll have okay, I can see the totals here. Then we'll have 1350. Then we'll have our retained earnings from our trial balance. We have 2400. There was no revaluation. It was 0. Our mark to market was 120,000. Right. Then we'll have movements during year. We have proceeds from issue of shares. Right. On ordinary shares were given. We're told that they issued shares worth the 1.2. On cumulative preference shares, we calculate there was nothing, but on non-cumulative, we calculated and we found that they issued shares of 300,000. Right. Then we then had capitalization issue. Our capitalization, we add on the ordinary shares. Our capitalization was here. $855. Then we subtract from retained earnings. Capitalization, we then subtract from retained earnings. Right. Then our profit for the year, or in fact, actually, we can just call it total comprehensive income. It's made up of 3 things. our profit for the year goes under the retained earnings, which is this one that we calculated here. Our revaluation will go under the revaluation. We calculated on number 1, and we found that our total revaluation was 552941. Then our mark to market, it was 67,500. Right. Then we have got ordinary dividends. The ordinary dividends we calculated, we found that they were 342. Yeah. They will be subtracted from retained earnings. So you try that. If you have done your calculations, everything else will just be easy. Then preference dividends. We found that it was 360. Right. I think that's it. Then I don't think that we left anything else. Right. Then you get your balances at end of year. We add up. So that's our statement of changes in equity. Any questions there? Right. If you don't have any questions, can you please, during the week, look at the format of the statement of profit or loss and other comprehensive income? Sorry, a statement of financial position. So I'll do with you statement of financial position. And to do that, also look at property, plant, and equipment, although I'll also do it in detail. Thank you so much. God bless you richly and enjoy your weekend.
Thank you, sir.
So we'll be sharing the recording.